we were in negotiations, investing in real estate. They're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. This podcast has been so much fun and quite different than others that I've seen in that we help real estate investors and real estate educators build their wealth. If you're listening for the first time, maybe it's your second, third, whatever, please, if you haven't yet, give me a 5-star review and share this with a friend. Speaking of friends, I have another one with me today. Actually, a pretty close friend. I've known him for many, many years, Drew. Honestly, it's been over 15 years because I think I met you before I even started Pine Financial.
Yeah. In fact, when you and I were talking about doing this podcast, I remember going and visiting you at that little office up off of like Spear and 29th by that Mexican restaurant.
Yeah, you remember that?
I just remember the first time I think you and I met. So we're getting old, dude. It's been a long time.
Oh, man. So that is definitely over 15 years because I was in that office when I was working with Susan. I did that from 2006 to 2007. So in 2008, I started this company. So, wow, that's insane.
So we're bumping 20 years, bro.
Whoa, that's crazy. And I'm going to learn. I'm guarantee I'm going to learn something about you today that I didn't know. So I'm excited to dig in here. But for the listener, Drew McCabe has been, as you know, he's been in real estate, as we just talked about, for a long, long time. So he's a serial entrepreneur. He loves everything real estate. So there's not a lot he hasn't done. Rental properties, fix and flips, new construction. You were doing financing when I met you, and now you're the go-to for 1031 exchanges. So Drew, first of all, welcome to the show, man.
Hey, thanks, Kevin, so much for having me. I really appreciate it.
Yeah, well, let's get to know you. So let's start. Take us back. I know you love real estate as I do, as a lot of the listeners do. So how'd you build that passion? Where'd that come from?
Great question. So I was born and raised around it. So my dad was a real estate attorney. I grew up in Oregon, and my parents had rental property. So it was just in my blood. I kind of saw it from a young age. And then I got into the 1031 exchange business in like 99, 2000. I did mortgages for a short period of time. That's kind of when you and I knew each other. And then got into the 1031 exchange business. And then had a company, sold that off, and then have the current company I have now, which I started in like 2007, 2008. But along that way, as you know, you start buying different rentals, you flip some properties, you go to the auction, you do some lending, you do some syndication deals. Once you get into it, it gets in your blood and it just starts pumping through, and you're always looking for different fun ways to do different transactions.
Yeah, a lot of the people I hang around are very similar to you and I. It's just like we call ourselves deal junkies, right? I'm sure you've heard the term, but it's just always chasing that deal. Sometimes I wonder, man, like when's enough? Because I'm not losing the fire at all. I just absolutely love this.
Yes, I'm with you. I mean, I actually just put a property under contract yesterday. Put a contract, a kitty condo for my daughter. She's up at University of Wyoming. So this is my first foray into kitty condos. But yeah, man, it's just, I don't know what it is. It gets in your blood, and it's kind of addictive. Well, not kind of, it is addictive. And like a lot of you guys that you probably hang out with, you kind of have one core business that is your main business. For you, it's the hard money lending. For me, it's the 1031s. Maybe it's property manager, whatever. And then you use that as your as your core, as your base, and then do all your other stuff outside. So you pick up your rentals and, like I said, syndications, building, flipping, whatever it may be.
I'm reading Rich Dad Poor Dad to my 13-year-old right now. So every night we'll go in there. I have her 50% of the time. So I guess 50% of the time at night I go up there and I will lay down with her in her bed and we'll read Rich Dad Poor Dad. And what you're saying reminded me of that because he talks about stacking assets in that book, as we all know, right? We want multiple streams of income. So we want to buy real estate and start living off income from these assets. So that's kind of what you're saying. You have a business, maybe it's W-2, maybe it's whatever it is, something that you're passionate about, you enjoy, but getting that money out of that business and into assets. Is that what I'm hearing here?
Yeah, for sure. I mean, the 1031 exchange, as your listeners may or may not know, is a tax code that allows you to defer the gain on the sale of investment real estate and buy more real estate. And so I get to see a ton of investors on that side. We do, couple thousands of these a year. And so we get to see a ton of different transactions. So I get to see it from the finance or from the tax side of things. A little bit on the finance side, not as much, more tax oriented. But yeah, so that's my day to day. And then basically I take, my profits and earnings from there to go do more deals. And like you said, stack those assets. In fact, when people ask me about real estate, I always tell them, go read Rich Dad, Poor Dad. It was one of the first books I read. It's a lot of what I call cheerleader, but it gets your brain kind of thinking about the right paths to go down.
Yeah.
So great book.
The concepts in that book are amazing, and it's mind blowing, really, if you haven't read it. Most people probably have.
Sure.
In fact, I would say probably 100% of the people I've interviewed on the show have read that book. And quite honestly, a lot of them got their start in real estate because of that book. So super popular book.
Yep.
And I want to get into the 1031s and what you're seeing, because I know that the 1031s getting attacked constantly. Is it going to be here next year? Is it not? How long is this going to last? And we hear the deferral, right? But it's not a tax-free strategy. So I want to get into that as well. But I want to dig in just a little bit more about your progress here. So tell me about maybe the very first deal that you've done.
On the 1031 side, or me personally?
On your personal side. You're like,
on my personal side.
Yeah.
Well, the very first deal I did was I bought a condo. I graduated college in April, and then I bought a condo in June. And then or somewhere right around there, and then my wife and I got married. So we moved into that condo. We lived in there for probably less than a year, I think. Moved out and bought another house, and then converted that condo to a rental. I did that 3 or 4 more times. And so that was my first real estate purchase, not necessarily my first investment purchase. I can't really honestly remember my first rental property purchase, strictly rental, because we kind of turned those over a few times. But yeah, that was my first deal. I think I paid 92 grand for that property. I think I financed it at 6%, roughly, maybe 7%. Still have it today, which is crazy to think about.
Yes.
But it's funny because I'm in the 1031 exchange business, which is to sell and trade and buy up and stuff. I've actually only personally ever done one exchange for myself. Now, obviously, we do hundreds of them a month for clients. I really love to buy and hold on to stuff. I think that's always been my kind of my MO, is get rich slow. And so I flip some properties, but my rentals, I hold on to them for long periods. So yeah, buying the condo was probably my first deal.
And you still have it today. So
I still have it today.
Went right through the crash.
I did. Yeah, it was funny. I went back and I looked and watched my rents. And when I first rented it, and then watching the crash, and then watching it climb back up, it's just been a real kind of a fun learning lesson to show my kids and stuff. Like, hey, yeah, it was hard. I think I was negative cash flowing maybe $100 in like 08, 09, 10. And then, as rents climbed back up and got new tenants in, now, cash flows, well, it's all cash flow now because it's paid for, but, so yeah.
That's so interesting. So you have a lot of equity, obviously, and the return on equity is probably not great, and you're a smart guy, so you know that. But so let me ask you this: is it like an emotional attachment to it because it's your very first one, or what? Why the strategy to hold on to it?
Great questions, and I talk about return on equity a lot with friends of mine and other investors. So what I do is I pledge my paid in full properties on the line.
Okay, got it.
And then I pull off that line to make other investments. So, yeah, if you just look at my true return on equity, it's probably not great. But when I, average that out and do my blended return, it's much better than
Okay,
what
so it's pledged for collateral for a line. So I'm assuming there's several properties pledged to this line. Yeah. Okay.
Yep.
And is that the reason you're holding on to it, or why hold on to? I know you. Let me back up. I know you're wicked successful, Drew. You've done very, very well over the years. You absolutely know what you're doing. To keep a little condo surprises me just a little bit. So that's why I'm digging in here. Is it because you've been able to leverage it and it just adds collateral to that line, or is there something more here?
Might be laziness, not busy with other things, and you kind of set it and forget it. Really, that's kind of one of the other reasons I was actually talking to somebody the other day about short-term rentals. and I've always stuck with long-term. And really it's because I probably just have too much going on to be able to spend the time managing something like that. And I think the same thing happens with that rental. I've got close to 100 rentals, and so it kind of just gets thrown in the pot, and it's terrible to say. You kind of forget about it, because it's got a good tenant in there. I tend to find tenants. I tend to rent a little bit under market and get tenants who just don't bug me. And again, it's probably not the best way to get the biggest return on my dollar, but it allows me the time to focus on other deals.
Yeah, that's a very good answer. I have a similar story. I had a handful of properties in Memphis. There were 5 of them. Actually, there were 6 at one point. But anyway, there's 5, and I had a balance sheet review by one of coaches I work with. And so what he does is goes through the entire balance sheet income and just tries to poke holes in it, right? So it's like
Sure.
an hour and a half call, and just kind of basically, it feels like you're attacking me a little bit here. And that's the whole point. And what he told me, that what I got out of this entire process was, I got to get rid of those 5 houses because it's draining my time, and it's hardly any. It's like $600 or $700 a month each. So it just wasn't worth that for the equity and the time. And that one landed a little bit. So I did end up selling those.
Yep.
I think I have a handful more that I should probably look at here in Denver, and they're all condos. Condos for me have been a challenge because you've got neighbors and HOAs. So I have found single family much, much easier to manage. What's your experience with that?
I would agree 100%. I've got that one condo and I've got one townhome. So I've got 2 properties with HOAs. I've got some single families that have HOAs as well. That's a little bit different. But yeah, I mean, I can see every year it seems like my HOA cost is going up. Obviously you try to pass that along to the tenant. But on the flip side of that is, you're not dealing with any maintenance. You're not dealing with any, mowing or snow removal or any of that kind of stuff. So there is a bit of a balance. As you know, as well as anybody, condos tend to be the quickest to fall and rise too. So valuations will fluctuate on them. But I also think it's probably a good entry point for a lot of people who are getting in. And I don't know what percentage of the listeners are new, starting their process, or more seasoned like you and I, just looking to gain a little more, knowledge. So depending on where they are in their real estate journey, I think a condo can be a decent way to get started. I guess the lesson is, don't be dumb like me and hang on to it forever. But
I'm doing the same thing now. I think I got 5 right now in Denver.
Yeah. So 1031 and buy something bigger and
yeah,
better.
that's exactly where I was going, because I got to tell you, these are, even though I manage everything myself except for my condos because of the HOAs. It's easier for me to have a management company to just create a little buffer there.
Yep.
And I guess I can tell stories about that. I won't go there, but it's been a challenge. So I've been thinking maybe it's time for me to look at something bigger in 1031. The problem is, and this is where, let's get into the 1031s now, is once you decide to pull that trigger, there's like some timelines, and it can get a little bit tricky with the disposition,
Yeah.
and the new acquisition. So walk me through the process on how this works. And if I have 5 condos, what would you recommend?
Great question. So you're 100% right. 1031 exchange is a tax deferral. A lot of people think, oh, it's a tax-free exchange. You'll hear people say that. It is 100% not. It's a deferral. Now, there are strategies to eventually make that tax go away. And we'll get to that, but it is 100%
to die.
Yeah, it is. So the joke in our business is we call it the 4 Ds: defer, 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 and then die. And those of you that don't know, when you pass away, your heirs get your property at a step up in basis. And that's how the law stands now. Of course, they could always change the law. Who knows?
Yeah, I'm sorry to interrupt you there, man. I was like,
no,
what strategy can it be taught? I got it.
4 Ds: defer, defer, and then die. Or the other thing we say is swap till you drop. So just keep swapping until you're dead. But there is a little less morbid estate planning, where you convert a property that you 1031 into a primary residence. And then you can live there. It used to be you only had to live there for 2 years, and then you could claim Section 121 and make that gain go poof. Well, the IRS caught on to that 10 plus years ago. And so they've changed that rule, but you can, the longer you live in it, the more that gain will go away. So
But isn't that up to, like, it's capped, right? 500 grand for a married couple?
well, yeah, you're still limited to the 121 exemption, which is $250,000 if you're single, $500,000 if you're married. So you're right. If you have more than that, then obviously you can't make that go away. But
Gotcha.
one way to do it. But back to your question about the time frames. So in a 1031 exchange, there are 6 simple rules that you have to follow. The first rule is the property you sell and the property you buy must be held for investment purposes. I get calls daily from flippers, who I know you deal with quite a bit, who are like, "Hey, I've heard of this 1031 exchange. Can I flip this?" And I ask them, "Oh, tell me a little bit about the property, what you've done with it." And they'll say, "Well, I bought it 4 months ago and now I'm flipping it." Unfortunately, flippers do not qualify for 1031 treatment because they are considered dealers or developers from the IRS standpoint, and that income is subject to ordinary income. It's just like a short-term capital gains or ordinary income. So flippers, unless they hold a property for more than a year and rent it out and show some income off it, they're going to be excluded from doing exchanges. But anybody who holds something for at least a year and a day can potentially qualify for 1031 treatment. Same goes for the property you purchase. You need to hold that for long-term investments. So that's the first rule of the exchange. Now, to your point, the time frames the IRS allows you to do this. From the day you sell your old property, the disposition, not the deposition, you have 45 days to identify up to 3 properties you want to purchase. And then rule number 3 is you have 180 days to complete the transaction. So those timeframes run concurrent to each other. So the first 45 days is your identification period. Then you have a remaining 135 days for a total of 180 days to buy one of the properties that you want to identify.
So to actually close.
Yeah, actually close. Exactly. Yep. So the IRS allows you to identify up to 3. You can identify more. It puts you into a different category of rules that if anybody ever had questions, we can go into that deeper. But so that's the first 3 rules. Rule number 4 is you have to use a qualified intermediary. That's what I do. That's our job. Our function is to prepare all the paperwork that reflects the exchange. We actually have to hold the proceeds. So whatever your net proceeds are coming out of that property comes to us. We hold those on your behalf. We actually set up segregated accounts for every single one of our exchangers. So we set up hundreds of accounts a year for each one of our exchangers. The next rule is the title holding requirement. And what that says is however you hold title to the old property is the same way you need to take title to the new property. So if just Kevin owns the old one, then Kevin would need to buy the new one. Or if it's, Kevin's Investments LLC, the LLC would buy the new property. And then the last rule is probably the most misunderstood rule, and that's called the equal or up rule, or your reinvestment goal. And what that says is in order to defer 100% of the gain, you have to buy a property equal or greater in value to the property that you sell, and you have to use all the cash from the sale of that property into the purchase of the new property. There's a lot of misconception that says, "Oh, I only have to reinvest my gain, right? I made $50,000. That's all I need to reinvest." Well, no, you're selling this property for $200,000. You need to go reinvest $200,000 or greater into the new property or properties.
The proceeds, so not, the proceeds, right? So it's.
So it is.
It's the make sure I understand this.
Yeah. Just go ahead.
So if I sell it for 500, and let's just say there's a $200,000 gain. My basis is 3. I sell it for 5, but I still owe 250,000. So my proceeds, making this super simple, take all cost of sell out.
Correct. Yep.
So we're talking about a $250,000 cash proceeds. Is that what I need to invest back in, or is it the full 500,000 purchase?
It's the full $500,000 purchase. Yep.
What if I don't have another 250 grand to inject into it? I have to use that to pay off the mortgage.
Right. So your mortgage gets paid off. So you would have to go get a new mortgage on the new property.
Oh, I see what you're saying.
Yep. To replace the mortgage that you paid off.
Okay, perfect, Drew. So then let me ask you this. Can I go and refinance after I close out, everything's done? Can I go refinance and pull my cash back out?
Great question. In fact, we just had this conversation in the office 20 minutes before this phone call. Yeah, we call it the nanosecond rule. So you never want to refinance a property right before doing a 1031 exchange. So if you're thinking about doing an exchange, don't go out and refinance and pull that cash out. The IRS doesn't like that. They they always think the worst of us, right? So they think you're trying to pull something over. So what you do is you do your 1031 exchange, buy the new property, complete that transaction, wait, what we say is 1 nanosecond, then turn around and refinance the property. The IRS says you need to have a legitimate business purpose. So if you ever got audited and they were looking at the transaction and you pulled out 100 grand to go buy a Ferrari, that may not be a legitimate business purpose. But if you're pulling that cash out to go do another real estate investment deal or to start a business, that's obviously a legitimate business purpose. So always do it on the backside once you've completed the transaction. The other thing along that same line is a lot of people will say, well, can I just increase my new loan and keep that cash out of the exchange? And unfortunately, the answer is no. You have to use all that cash to purchase first, close, then go to somebody like Pine and say, hey, I need to borrow X amount of dollars from this thing.
Okay, so let's walk through this timeline because I'm getting tripped up here a little bit.
Sure.
So I've got 5 condos, and now you're telling me I have 45 days to identify. 135 days to close seems doable, reasonable. 45 days to identify, not so much. That's putting me into a situation where I might be overpaying for a property because I can't be patient. Now, if I have 5, is that clock start when the very first one sells then?
Well, so what you're kind of talking about potentially doing, you've got a myriad of different options. So you could sell one and go buy one. You could sell 2 or 3 and go buy 2 or 3. You could sell 2 or 3 and go buy one, or you could sell all 5 and go buy one. So really,
okay, got it.
Yeah.
I want to sell 5. I want to buy one building that's I own the whole building.
Yep. So we call that a consolidation exchange, right? You're kind of tired of managing those 5 condos. You want to just go buy a nice 4-plex all under one roof. Really, each one of those sales are going to have their own timeframes running. But if you're going to try to consolidate all 5 of them into one, it's really that first sale that's going to trigger that timeframe running.
That makes it tricky, Drew.
It does. So there's an answer to that. There's what's called a reverse exchange, where you can buy the new property before you sold the old properties. The IRS says you're not allowed to use 1031 funds into something that you already own. So if Kevin goes out and buys that new property in your name, you then can't 1031 the condos into it because you already own it. So in a reverse exchange, what happens is we, as the qualified intermediary, we set up what's called an EAT, Exchange Accommodation Title Holder. And that's basically a shell LLC. It's a brand new entity, has no assets, has no liabilities. It goes out and it buys the new property on your behalf and parks that property. Now, the issue is this entity doesn't have any assets, doesn't have any cash. It's going to look to Kevin to either come up with the cash or have a financing relationship where the lender will loan to the LLC backed by Kevin as the personal guarantor. So like in Pine's situation, Pine would loan to that LLC, but the client would still be the personal guarantor. Pine would still have the deed of trust against the property. There'd be a note, everything like that. We're just parking that property and we're turning around and we're giving the client, in your case, we'll say you, the exclusive option that says we can only sell this property back to you.
I see how that works.
Yep.
Okay.
So now we've parked that property for you. We've got your replacement tied up. Now we can start selling off these 5 condos. Either maybe you sell them as a package or you sell them one at a time, but now the timeframes aren't as important because you've already got your new property locked up. So again, I'm going into a lot of detail because there's really a lot of different options and each person's transactions are always different. But in our scenario here, let's say you sell the first condo and condo 2, 3, 4, and 5 just aren't moving. You could come in, buy a portion of this property. So let's say you're going to buy 20% of the property to complete that first exchange. So now that exchange is done, those timeframes are done running. Okay. Now condo 2 sells and condo 3. So now we've got 40% to come in and buy a chunk. Again, this is just one of many, many different ways that a reverse exchange helps. We do a ton of reverse exchanges for these types of transactions. They are a more expensive, complicated transaction. You can already see, number one, our fee. Number two, the financing, because you got to get that financing in place to buy that new property. So they are a complex transaction. They're not, I wouldn't say they're for the very beginning investor, but man, they are a powerful tool. In fact, we're working on one right now in New York that's about a $5 million purchase, and they're buying a kind of a glamping RV park. And so there's a real estate component, there's a business component, there's a blue sky component, there's some personal property, and then they're selling off I don't know, I think a 4 unit or something in California. But they couldn't get California sold in time. They needed to buy New York first.
I've heard about these 1031s. I didn't know the details as you just described it. So that makes it so much more clear to me that you've actually already gained control of it in an outside entity, and that controls the clock there. I mean,
Yep.
the 45 days still starts when
Still
the first
short.
condo sells, but
Correct.
you still have you have a lot more control. So it's going to cost more money. We could talk about the pricing difference, but my guess is I would save more money on being patient and looking for quality replacement than it would cost me to do the reverse.
Yeah, for sure. 100% agree with you on that. And back to your original point about, you know, if you start this exchange, that 45 days goes really quick. And I tell people it moves really fast. Does that create you to be buying something that may not be the quintessential property that you want, or the exact return that you want? And does it limit your negotiating power? I have clients all the time that are in exchange, and I tell them, hey, when you're negotiating on your replacement property, don't tell them you're doing a 1031 exchange. You're not hiding anything. You just don't need to disclose that at that point in time. Because I think it does take a little bit of your negotiating power. You don't see it a lot, but I have seen it where clients, the seller knows you're within your 45 days, and they kind of got you by the short hairs a little bit. Again, it doesn't happen a lot, but then I tell people, hey, once you've negotiated the transaction, you've got things firmed up, then you obviously go in and say, hey, we're doing this as an exchange. And a lot of times the sellers don't really even know what an exchange is. You may be buying their primary residence or something that doesn't make a difference to them. But that is definitely, as far as, I always like to look at, positive and negatives of doing things. The positive of the exchange is obviously the tax deferral, your increased buying power. The negative is a deferral, right? So you're not making that tax go away. And then the timeframes, you're on a kind of a short leash.
Yeah. And even if you do defer and decide to liquidate before you die, I mean, there's a chance you're in a lower tax bracket, so that capital gain may go from the 20 plus the Obamacare bit down to 15. So I guess that's something else to consider as well.
Yeah.
But I'm going to flip this a little bit and just get your opinion here, Drew, because this is something I experienced personally. So if I'm selling a property, let's say I'm a fix and flip investor, and I'm flipping what might be a good investment for somebody else. A lot of money coming from California in these exchanges right now. So I get a buyer and they do disclose that it's a 1031. My first thought is, oh, well, that's why you're agreeing to pay a little bit more than what I was expecting to get. One, so that could be a benefit to me to work with someone that's got a 1031. But two, you might have identified two other properties you can only close on one. So how do I even have confidence that you're going to close on this one? And in the example I'm thinking of right now, they didn't close. They strung me along all the way the whole 135 days and then let me down.
Well, yeah, that's, I don't really have an answer for you on that. If they had backup properties, then they may have they could have been playing people against each other too.
Oh, for sure. That's exactly what they're doing.
Bringing you out and the whole 9 yards. So, on my side of things as the QI, we don't see that as much. We're in conversations obviously with our client, but we're more like making sure that you're meeting the requirements of the exchange. The negotiations is really with the realtor and the client. So we don't see that as much.
Interesting.
But it does happen.
Yeah. I don't know every time I've sold a property if it's been 1031 or not, but a lot of them do disclose that, surprisingly. And I know your advice is to don't, but I've been told many times.
My advice is to don't when you're negotiating, but once you've negotiated price, then you disclose, and they're going to be disclosed by the document.
It has to be. Yeah, exactly. Okay, gotcha.
Oh,
That makes
yeah,
that makes sense.
sorry, I don't want to say don't do anything illegal by any stretch. It's not illegal, but yeah, I always just say don't tell them you're doing an exchange until you've negotiated that price, either firm on your inspection items or whatever, and then you're like, oh, we're doing a 1031 exchange.
Okay. And I know for
Again,
the most part, we're talking to a listener that might want to use a 1031 exchange, and obviously you do that, so that's what you're hoping for. But again, if I go back to the other side and the fix and flipper, here would be a piece of advice I'm thinking, and you tell me if you agree with this, and for sure tell me if you don't, so we could chat
Sure.
about it. But if I found out someone was a 1031 and they're writing an offer, I may or may not take that. So I would be turned off by that, honestly. But once I have the contract, I probably wouldn't renegotiate because I know they're pinning me up against other identified properties, one. And two, if I am trying to renegotiate, if they are trying to buy more time, I would put a very strict deadline and then just move on, because otherwise you're going to get drug on through the process. So be very, very hard and strict with a 1031 buyer, in my opinion.
Yeah, I think I might disagree a little bit. I don't think it changes. I mean, they're still, if they're doing 1031 or they're not, I don't think the 1031 is going to be the hang up of why they may or may not be buying the property. It could be. I actually feel like when they're in a 1031, if they've identified your property as one that they want to buy, you're one of three, versus if they're not,
point.
you could be one of, well, there's not a lot of properties on the market right now, but you could be one of 50 or whatever.
That's a great way to look at that.
So that would be my thought process. But I hear what you're saying wholeheartedly.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
You had brought up, you'd mentioned the 1031 exchange and going away. I didn't want to.
Let's talk about it. Like, we got another 10, 15 minutes. So tell me what's going on right now, because I know this comes up, like, especially election year.
Exactly. 100%. Election years always comes up. Like I said, I've been doing this for 24 years. So we've gone through a couple of different election cycles. It came up under Biden, not, I don't want to be political by any stretch, but it came up under Biden. And it comes up, it seems like, every single year. In fact, actually under Trump, they changed the 1031 exchange. It used to be you could do real estate and personal property. And Trump went away and did away with personal property. So fortunately for us in our firm, we focus mostly on real estate. And so the personal property didn't affect us at all. But there are some firms that's all they did was personal property exchanges, and it went away. So that was the last major revision to 1031 exchange. When Biden got elected, they talk about it a lot, because they're like, well, we could be getting all this money on these capital gains. It was either Ernst & Young or Deloitte, one of the big firms, did a large study on 1031 exchange. And people will always ask, well, why does the government let you do this? Why wouldn't they just get their money and take it from you? And what people don't realize is the 1031 exchange is really an economic generator. And so when a 1031 exchange happens, right, you're going to have in a straight exchange, you're going to have two closings within a 180-day period, right? So you've got a realtor getting paid, you've got a title company getting paid, you've got an inspector getting paid on the sale, you got a 1031 exchange company getting paid. Then on the purchase, you got two more realtors getting paid, inspector, a lender, and so the 1031 exchange transaction is two transactions within a 180-day time frame, and really they happen much, much quicker than that. I think on average, our deals are less than 60 days from sale to purchase. And so what has happened is you have all this ordinary income that has been generated from this one transaction, that oftentimes will offset at least the capital gains tax. Because remember, the IRS is taxing that as ordinary income. So low end 25%, for guys like you and me, it's 40%. And so they just got a whole bunch more income versus maybe only getting that 20% if the person just sold the property and paid the tax. So all that to say, this report basically showed the administration, hey, if you kill 1031 exchanges, you're really going to kill the commercial real estate world, because almost every commercial real estate transaction, not everyone, but a high percentage, I think they said 70+% of commercial real estate transactions have a 1031 component, either for the buyer or the seller. And so if you do away with that, you would just really crush the commercial real estate market. And so they talk about it. It's kind of, I think it's more to appease their base, more or less, on either side, not again, not being political. But it's like, oh, we're going to look at this, and then, a war happens in Ukraine, and let's focus on that and forget about this. So
Yeah.
1031 exchange have been around since 1921, so it's 100-year plus tax code. Again, I may live in an echo chamber because this is my living, and obviously I don't want it to go away, but I don't foresee it changing, right away. And if it does, it is what it is.
Yeah, I don't think it's going to change either, because I agree with you. I haven't read that study, but I can't even imagine how many people would just decide to keep their assets. Like, if I have to pay tax on it, and I won't if I just keep it until I die, why would I sell it? So, I mean, I think just common sense would tell you that would, I don't know if it's crush is the right word, but that's the one that's coming to my mind.
Yeah.
It would definitely impact commercial real estate, no question about it. What
Yeah,
I
I
do
mean,
think,
you can kind of use the well, in Reagan did away with the partnerships back in the 80s. There was some benefits of that, and again, I don't know a whole lot about it because a little bit before my time, but it really hurt the real estate market for a long time. So I kind of equated to that, changing those types of rules. And I live in an echo chamber, but I would hope that they don't do away with it, because my business.
and the economy is going to be the focus of this election. We haven't been really hearing about it all that much, but I would not be surprised if this one pops up. And I agree, though, man, I don't think it's going to happen. So I am personally not concerned with it. I'm way more concerned with all the regulation around landlords. So owning a lot of properties. Now that's a different episode, but that one has me much more scared.
Yeah, well, I mean, I know we're not talking about that. We're talking about 1031s, but I actually stopped investing in Colorado a while back. I still have a decent portfolio here, but I went out, started buying Tennessee, not Memphis, but Chattanooga. But man, I keep seeing all this stuff popping up, and I'm like, man, I should just liquidate, get out of here, 1031, and go buy stuff in a more landlord-friendly state. Again, politics aside, it's getting crazy. It's really getting crazy.
And there's so many, like, let's say the just cause eviction, for example. There's like so many examples of this not working. If you look at it, like in different parts of the country where it's happening, it's just what ends up happening is rents go up higher, right? Because you can't increase it only a certain amount. Like, so this is a rent control, not the just cause, but that's an issue too. But the rent control, there's studies that show that rent actually goes up higher in rent control.
Yeah.
And not to mention what's happening right now. I mean, just today, and I know this isn't going to post for several weeks, but God, I don't know if New York Community Bank is going to be around by the time this thing actually posts, because of rent control. So it's a problem.
Yeah, because what was like 80% of well, I don't know if it was that high. What percent of the portfolio was basically rent controlled buildings? I was just reading the article today. Funny you bring it up. It was some high crazy amount.
The 80% you're thinking of is how much stock value has been lost since they announced the trouble with those assets.
Okay.
So that's where you're getting the 80%.
Their portfolio it's way up there of rent controlled buildings. Yeah.
Yeah. And that's their own loans they originated, but they bought a toxic bank, right? They bought Signature. So they're taking on problem. Why would you do that? I don't know. I don't see a way out.
Yeah.
Anyways,
You know,
we digress.
guys smarter than you and I are going to make money on this thing, whether it fails or goes forward.
Totally.
Somebody's going to make money, I guarantee you.
Totally right. But real quick to wrap up on the legislation, we do have a lot of listeners in Denver and Colorado. It's specifically
Yeah.
Denver that's as a problem. And Drew, we're getting a lot of people calling that are selling their rentals. They don't even want to buy another asset. They don't want a 1031. They want to get rid of it, pay the tax, and get out. And so a lot of people are starting to invest with our company and selling their rental properties. I don't know if you've heard of this, but there's a trust out there that's kind of going head to head with 1031s, and it's starting to gain some traction. It's called the Deferred Sales Trust. Have you heard of this?
I have. I won't speak to it because I don't know it very much. It's one of those things you kind of hear a little bit about, but I don't know how vetted it is. That would be my personal thing. Is I know roughly a little bit, but I don't want to speak about it because I can't speak intelligently about it, other than I've heard that it's not fully a vetted type of transaction.
I think there was a release from the IRS to be careful with it because some of the promises that are being made. So I don't know. I'm going to look into it, but it's a way for you to potentially defer some taxes, selling a real estate asset and investing in non-real estate assets. So that would be the only time to look at this. Sure. Obviously, if you're going from real estate to 1031, tried and true, that's the way to go. And Drew, you've been
around forever. So.
And you've been doing this for a long, long time. And you know this business, and not only 1031s, but you know real estate. When I met you, you were a private lender. I know we've done some deals. We've talked about that a lot. So you understand the business. So that's someone I would want in my corner if I was looking at 1031. So appreciate you coming that.
On.
Appreciate you coming out.
Finish my sales pitch, I guess, is, we do 1031 exchanges. We're based here in Colorado. I got offices in Texas and Florida, Michigan, northern Indiana, but we do them nationwide. So if you're selling Florida and buying Texas, or selling Colorado and going to Michigan, because 1031 exchange is a federal tax law, we can do them anywhere. A little bit what makes us unique is we're an independent. So there's a lot of 1031 companies that are owned by title companies that can help you as well. We're independent, so we can work with anybody. And then we also pride ourselves on our knowledge and our education. So we do a lot of continuing education for real estate agents, investors, that type of stuff. And then the more complicated transactions, some of the 1031 companies owned by title companies don't do reverse exchanges or improvement exchanges, things like that. So I guess if I can give you my sales pitch, I'm always a proponent of working with the smaller, independently owned, entrepreneurs like Kevin and I, versus, the big giant conglomerates. But again, everybody, as long as they're doing the proper documentation, they're protecting your money correctly, whatever, that's the most important thing. But
Yeah, and I was gonna lead right into that commercial, but before we do that, I was gonna go through a quick summary of what I learned today from Drew here. So obviously, we talked a lot about 1031s. I would love to get into your education side because that's what this show is all about. Mm-hmm. We're all trying to educate each other, and specifically on this show, educate real estate investors to try to attract business from it. So I wasn't able to do it, but I would like to at some point maybe get into that. Like, what education do you provide, and how is it working? How are you doing it? And how are you getting benefit from it? But what we did learn today was obviously a lot about 1031. So we know we need to do it for investment purposes. We know we have 45 days to identify once we sell if we're doing a standard 1031, 135 days to close. You got to use however you're own the property, you got to have that as the same buyer of the new property. Obviously, you got to use an intermediary. Sorry, did I say that right? That's a hard word for me to say. So basically, use Drew.
QI. That's what
QI. So I'll put that on my notes. Use a QI, and then it's equal or up. And then the real nugget here, y'all, is the reverse exchange. I'm a big fan of it. I've seen it in action. I didn't know the specifics as well because I haven't done one personally, but I have friends and colleagues and clients that have used it. The reason for that, again, is because they don't want that pressure of the 45 days to identify, that really could force you to pay more for a property than you want to. So I
Mhm.
highly recommend looking into that reverse, because that keeps the negotiating power on your side. Anything I missed?
No, the only thing I would clarify is it's a total of 180 days. The 135 is after your 45 days.
Yep.
So 45 and 180 day
Good.
time frames is what we call. But yeah, that's the only clarification.
Good.
No, you hit the nail on the head.
Yeah, I think you did a great job. There's a couple things I'd like to dig in, but we really got to wrap this up. So now, anything else you want to share, and then share your contact info?
No, Kevin, thanks so much for having me. I think before we started recording, we couldn't decide who owed each other beers. So
That's right.
I'll get you. Contact info is Exchange Resource Group is the name of the company. Our website's www.erg1031.com. Phone number is 303-789-1031. Imagine that. Feel free to give us a call. We're here to help you understand exchanges. Even if you're just thinking about doing something in a year or 2 years, whatever, or you just want to gain knowledge, call us up. We'll answer your questions. You can talk to me, or anybody else in the office can help you out. Real briefly on the education piece, we do continuing education for realtors. We send out a monthly newsletter. If you call us up and sign up for that, we typically do a monthly, just 30-40 minute Zoom call. So you can just log on. We'll walk you through exchanges or reverse exchanges, whatever it may be. We just want people to understand how they work, the power of them. We didn't even talk about the power of growing your portfolio and your additional down payment, more money that you'd have to put down. I mean, you and I skimmed the surface on a lot of this stuff. So call us up. We can go more in depth. And thanks so much, Kevin, for doing this. Not only for me and letting me kind of say who I am, but for everybody investing. And guys, listen to what Kevin says. He has done it. He's doing it. He's going to continue to do it. And most importantly, is he does it right. And that's the other thing, is surround yourself with people who've done it right, and going to keep doing it right. And that's Kevin and Pine.
Yeah, thank you for saying that. You wouldn't be in business as long as you and I have if we weren't, right? It's
100%.
Yeah.
Yep.
So
there's no way.
erg1031.com, erg1031.com. Mr. Drew McCabe, good friend. So glad that you joined us, man. Let's grab a beer. I'm totally on board for that. And for the listeners, I hope you got something out of this. Please 5-star review and make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.